think the first few years, which were really 2004, 2005, started off relatively slowly. I think the business was really driven by operating businesses, professional services business, and corporate finance, as well as at that stage we had a stockbroking business, which was in its early stages, and we were just starting our property activities. Our view was that if we were going to make the kind of headway that we envisaged, fulfill the kind of ambitions we foresaw, we would need to grow our balance sheet, grow capacity to invest in those businesses, to be able to draw the kind of professionals we would need to grow those businesses and start offering a diverse amount of services. So we took a view that being black professionals, we ourselves could participate in what was a prevalent BEE investment space. And so we used the combination of our corporate finance skills as well as our deal making skills and the fact that we were black professionals to start looking for financial transactions. And we were very successful. So between the period 2005 to 2007, we invested in a number of different companies. I think a lot of them were small emerging companies. Our view was that these were companies we wanted to actually grow with. It didn't make sense for us, for example, to become a 2.5% shareholder in Anglo American, where you'd hope the share price grows one day and ultimately you could cash in. Be that as may, I think with hindsight it might not have been a bad strategy. Nevertheless, I think we wanted to, sink our roots into companies that are deeply invested in South African infrastructure, and we would grow with those companies. And so we invested in a lot of companies which ultimately listed on the Altex exchange. I think the second thing is that given the size of our balance sheet, it only made sense that we were going to have to borrow a lot of that money from the banks in order to invest. Being corporate financiers, people who had raised capital for other, black companies and black groups to invest in these sort of things wasn't really a problem for us. And so we had a high level of success in terms of acquisitions that we made, and we actually had no problem funding them. Raising money to fund these transactions was the least of our challenges. What we would not have foreseen was obviously the global financial crisis in 2008 and the extent and viciousness of the adjustment in share prices. And I think the last thing you want to do in a scenario like that is be caught with a lot of debt and falling share prices from an investment point of view. I think the second other thing that was a big challenge was that these were shares that were not easy to hedge out. They were tightly held, in most cases family-owned businesses, and so we found ourselves in a scenario where we couldn't actually hedge ourselves against falling share prices. So we took a very hard knock from that point of view. I think our saving grace was that we had already started to build operating businesses. Our stockbroking business was going quite well. I think we had got a lot of traction in our property development business. We'd started assembling a portfolio of properties with the objective of actually building a property fund. We were very active in the corporate advisory space, raising money for state-owned enterprises. We were issuing bonds to fund infrastructure, especially as we were leading up to the World Cup. Other M&A transactions. So our operating businesses were going quite well. But I think obviously the adjustment in share prices hurt the business to a large extent. And unfortunately, I think it was a feature of the way that I think black companies were viewed at the time, that these were companies that were effectively there to really just invest in BE transactions. And therefore, when share prices adjusted, people just felt that, and investors felt that, prospects looked pretty dim. We could have basically, I suppose, given up and cashed in and seen the demise of this company, but we really believed that the story hadn't unfolded. We still hadn't told it the way we wanted to tell it. We still believed in what we were doing, but in all fairness, we were facing some pretty insurmountable challenges, and we decided to be proactive and to engage the banks that had funded us with a view to finding a way that we could restructure our debt. It took quite a while. It actually, it was only in around the first quarter of 2010, so you can imagine some 2 years later that we were able to finally reach agreement around the restructuring of our debt. It culminated in us doing a rights issue, which was supported by one of the bigger banks, and some compromise with some of our creditor banks, which gave us a bit of time. I think that was quite significant for us. It gave us quite a lot of stability, having had a 2-year period where a lot of our energy was really just focused on keeping this business alive and surviving. And that enabled us to start to refocus kind of on the future of the business, what we wanted to do. I think that initiated a change in strategy and tech, from one where we had envisaged that we could grow our balance sheet and use the cash that from our investment activities to try and strengthen our business, to one where we would need to focus really on organic growth of our existing businesses. As I said, what had been fledgling businesses had started to actually pick up. And really that's been the theme that's been prevalent over the last, from the period 2010 to date.